Now that we have a basic understanding of the present value of cash flows, let's take a look at some of the discounted cash flow methods we can use when making capital investment decisions. So if we remember, the payback method and the accounting rate of return were good tools, but they did not recognize the time value of money. So now we're going to take a look at the net present value and the internal rate of return, which do utilize this present value. So when we're looking at net present value, we're looking at the difference between the present value of an investment's net cash inflows and the investment's cash outflow, initial cost. So let me highlight this for you here. So what we want to know, we know the investment's initial cost, and if we're paying for that all on the front end, then we have the present value of the cost. But what we want to compare that to is the present value of that investment's cash inflows. Okay, and we would like for the inflows of cash generated by that investment to be larger than the initial outflow. But we have to get these in the same time period, preferably present value, to make this comparison. So with the present value calculations, we need a principal amount, which is either our which is going to usually, in the situations we've looked at so far, be an annuity of the cash flows that are coming in over the period. And we need to know the period, whether they're coming in for 3 years, 6 years, 10 years, and we need to know an interest rate. So that interest rate in our net present value calculations is called a discount rate, or the minimum amount, the minimum rate of return that management wants to obtain on a capital investment. This is the interest rate that we will use in our tables. So if we have two different scenarios in your textbook, that the company has decided they need a large piece of machinery to manufacture laptop and desktop computers, and so they have anticipated the expected cash inflows for each of these two projects. As you can see, the cash inflows are significantly higher for the laptop computers, $1,527,000, compared to the $1,440,000 for the desktop, but the desktop cash flows are higher on the front end, so you would be receiving more cash earlier on. And as we just mentioned in our prior lecture, that cash today is worth more than cash tomorrow. So in order to make a truly good analysis, we need to bring these values to their present value. So if we expect that the laptop project is going to generate the $305,450 of cash inflows each year for 5 years, then we have calculated, using those present value tables, the present value of this laptop project to be $48,610. How did they get there? Well, we knew from our table above and the information that your text has shared with you that there was a return, or there were cash inflows of $305,450 a year for 5 years if we're using some machinery to manufacture laptop computers. So I calculate the present value of an annuity because this amount is coming in over a 5-year period. So we would go to our annuity of a present value factor table in your appendix, and we know that it's covering a 5-year period, and our discount rate is 14%. Our managers have said we have to generate at least a 14% return for this investment to be profitable for us. So if I can calculate the net cash inflows, the present value of $305,450 over 5 years with a required 14% rate of return would generate the present value of those inflows to be $1,048,610. So if these are our inflows for that are going to be generated as the result of a $1 million investment, then my present value is positive. So it does generate enough profit to cover the return that is required by this organization. Now, once again, if our basic decision rule simply says that if the net present value is positive, the amount that I'm going to receive in inflows over 5 years compared to my outflow over 5 years, if it's positive, then I have met the minimum return that's required by the organization, and I could invest in this project. However, we also have to take into consideration what happens with the laptops, where that cash inflow is not the same amount every year. So instead of receiving $305,450 every year for 5 years. In the example for our next project, we would receive $500,000 the first year, $350,000 the second, $300,000 the third, and so on. So in this particular situation, I can't calculate the present value of an annuity factor. I have to calculate the present value of a lump sum each year. So I'm using the present value table of a lump sum, and I'm going to look at the present value in year 1 of $500,000. The factor, if you were using the present value factor table and you scanned across the 14% period and the 1 year period, you would find 0.877. Then I'm going to look at the present value of a lump sum of $350,000 in the second year. So now in the present value table, I'm using 2 years and 14%. So basically, I'm calculating the present value of a lump sum every year because this is not a series of equal payments over a 5-year period. So when I've calculated the total present value of my cash inflows using this method, it's $1,078,910, and I've initially put in an investment of $1 million, so I have a positive present value of $78,910 for the desktop project. This is somewhat larger than the present value for the laptop project. And we can make a comparison between these two because they both were the result of a $1 million investment over a 5-year period. So with just this basic information, the second project or the desktop project is actually more valuable to me using the net present value tool measurement. Now, there's one other consideration that we need to look at here. What about the residual value? Let's assume that out of this project that we're going to be investing $1 million in, it will have a residual value of $100,000 at the end of its 5-year life. Now we have to take that cash, that is a possible cash flow also, and we need to take it into consideration. So if we go back to our laptop project where we had cash inflows of $305,450 a year for 5 years at 14%, we calculated the $1,048,610. Now I need to know, okay, the present value of $100,000. But now remember, for our cash flows of $305,000 a year, we were using the annuity table. Now we simply want to know what is the value of this one, the present value of this $100,000 using the same 14% in 5 years, but I'm in my present value table. It is a lump sum that I want to determine what would this $100,000 be worth today. 5 years earlier, it would be $51,900. So now we can see that our total cash inflows from our annuity or from our series of operating inflows or cash inflows over the period plus our residual value generates a net present value of $100,510. So if the laptop project has a residual value, now it is a more valuable investment than the other two. Once again, we can make those decisions because they were all $1 million investments and they were all over a 5-year period. But what happens if we have where our initial investment amounts differ? Then we can't simply use our net present value method. We would need to look at what your book calls a profitability index. And so they've given you a different scenario for our company. Let's say that we are investing $125,000 for project A, $200,000 for B, and $150,000 for C. If this is the case, now I can't simply do a net present value calculation because I've made different investments. Right? They've already done the math for you to calculate out what the present value of the cash flows of these 3 projects would be. And when we compare those to our initial investment, what we see is that project B generates the highest present value when we're looking at different investments. This is called a profitability index. And it's simply calculated, as we can see, they provided for us here. What is our index? What is the present value of your net cash flows and we divide that by our initial investment. Well, they've set us up to do this. We've calculated the present value of the net cash flows, and if we were simply using the net present value for our calculation, we would have looked at $38,000. Simply inflows minus investment, inflows minus investment. So using the net present value method, we would have looked at project B because we have the highest net present value, but we also have the largest investment in this project. So when we convert that to the profitability index with the present value divided by the initial investment, we see a different type of decision emerge. The inflows divided by investment, 238 divided by 200, 182 divided by 150. Now our profitability index indicates that project C is actually the most valuable of these three investments, okay? Because all of our assumptions are not the same. And so if we were to do this profitability index comparison with our desktop and laptop projects without the residual value, we see this emerge as well. The present value of our inflows divided by our investment is 1.079 versus 1.049. The desktop is what we see emerging as the most valuable in our profitability index. And if we back up, we can see that without the residual value, the desktop was indeed the most valuable of our investments, 78 or 79,000 compared to the 48. And so the net present value and the profitability index showed the same results because we have similar assumptions in each of those situations. All right, we've discussed the net present value method. Go back and review these calculations, make some notes, and we will finish the discussion of this objective with the internal rate of return tool for capital investment decisions.